Two of your coworkers start investing on the same day. One puts in $200 a month starting at age 25. The other puts in $200 a month starting at age 35. Both stop at 65. Both earn the same return the whole time. The one who started 10 years earlier ends up with almost double the money. Not because they invested more. They invested less overall. They just gave their money more time to grow on itself. That's compound interest. And most people go their whole working life without really understanding how it works. Tonight, you're going to understand it. Not the textbook version, the version that actually changes what you do with your next paycheck.
Let's start with the basic mechanism. Interest is what you earn for letting someone else use your money. When a bank pays you interest on a savings account, that's them renting your cash. When you invest in the stock market, your interest comes from growth and dividends instead. Simple interest only pays you on your original amount. Put in $1,000 at 10% simple interest, and you earn $100 a year, every year, forever. Compound interest is different. It pays you on your original amount plus every dollar of interest you've already earned. Year 1, you earn interest on your $1,000. Year 2, you earn interest on your $1,000 plus year 1's interest. Year 3, you earn interest on all of that combined. The pile you're earning interest on keeps getting bigger.
That's why it exists in finance at all. Money has a time value. A dollar today can be invested and grow. A dollar next year hasn't had that chance yet. Compound interest is just the math of that head start, stacking on itself. Why does it matter so much? Because in the early years, it barely feels like anything. Then somewhere in the middle, it starts moving faster than your contributions do. Here's the mistake almost everyone makes with it. They think compound interest rewards big deposits. It actually rewards time more than size. Let's meet someone real. Call her Maria. She's 26, works in Ohio, earns $58,000 a year. She starts putting $300 a month into an index fund. According to Federal Reserve data from its survey of consumer finances, 54% of American households report having no dedicated retirement savings at all. Maria's already ahead just by starting.
She keeps contributing $300 a month for 40 years, until she's 66. Using the long-run historical average return of the S&P 500, close to 10% a year according to market data going back to 1928, her contributions total about $144,000 over that time. Her account balance ends up well over $1 million. Most of that final number isn't money she put in. It's growth on growth she never touched. Now picture her coworker, James. James waits until 36 to start. He puts in more each month, $450 instead of $300, trying to catch up. He still ends up with noticeably less than Maria at 66. Same market, same return, more monthly effort. 10 fewer years of compounding beat him anyway.
Before we go further, let's define a term you'll hear a lot in this space: principal. Principal is simply the original amount of money you put in before any interest or growth touches it. Maria's principal is every dollar she personally contributed, not counting what the market added on top. People confuse principal with total balance all the time, and it leads them to underestimate how much of their future wealth actually comes from growth, not deposits. There's a shortcut for estimating how compounding plays out called the Rule of 72. Divide 72 by your expected annual return, and you get roughly how many years it takes your money to double. At a 10% return, that's about 7.2 years to double. At 6%, it takes about 12 years. It's not exact, but it's close enough to plan around, and it's the kind of number financial educators use to make the concept click. Compounding doesn't just apply to investing, it also works against you in debt.
Credit card APR, or annual percentage rate, is the yearly cost of borrowing, expressed as a percentage. Most cards compound daily. Carry a $5,000 balance at 24% APR, and you're not just paying 24% a year. You're paying interest on interest that built up since yesterday, every single day. According to Federal Reserve consumer credit data, average credit card interest rates have sat well above 20% in recent years. That's the same force that built Maria's $1 million working in reverse against someone carrying a balance. This is why debt payoff order matters so much. High-interest debt compounds against you faster than most investments compound for you. Paying it off first isn't just cautious. It's often mathematically the better trade. Let's talk about where this shows up in retirement accounts specifically. A 401k is an employer-sponsored retirement account, often with an employer match. According to Vanguard's How America Saves report, the average 401k balance sits far below what most people assume, with a median balance well under $50,000 across all participants. Part of that gap comes from people starting late. Part comes from people cashing out early when they switch jobs, which resets the entire compounding clock back to zero. Every time you pull money out of a long-term investment early, you're not just losing that money, you're losing every year of growth that money would have generated going forward. That's the real cost, and it's invisible until you run the numbers.
This connects to something psychological, not just mathematical. Behavioral economists call it hyperbolic discounting. It's the tendency to value a dollar today far more than a dollar years from now, even when the future dollar is worth more. It's why lifestyle inflation creeps in so easily. You get a raise, your spending rises to match it, and the extra money never reaches an account where compounding could work on it. Compound interest rewards patience specifically because most people's brains are wired against patience. So what actually moves the needle, practically? Starting earlier beats contributing more if you can't do both. Automating contributions removes the willpower problem entirely. Avoiding early withdrawals protects years of compounding you can't easily rebuild. Paying down high-interest debt first stops compounding from working against you. None of this is a guarantee. Markets go up and they go down, sometimes for years at a time. Past average returns, like that roughly 10% S&P 500 figure, describe history, not a promise about your future. This is general financial education, not personalized advice, and a licensed financial professional can help you apply it to your specific situation.
Think back to Maria and James. Same effort and spirit, very different results. The gap between them wasn't talent, income, or luck. It was time, and what compounding quietly did with it. Every paycheck you don't invest is a small decision about how much time you're willing to give up. You don't feel that decision today. You'll feel it in 30 years, one way or the other. If this changed how you think about your next paycheck, that's the whole point of this channel. Drop a comment with the age you started investing, or the age you're starting today. Someone reading it might just start because you did.